I want to continue this market conversation now. We're joined by Kelsey Berro, JPMorgan Asset Management. Kelsey, I do want to start with the jobs report. Pretty solid figures here. U.S. economy adding about 560,000 jobs. However, this is still a miss on some of the expectations. However, not as big a miss as we saw in the April jobs report. Just curious just to get some reactions from you to the report. Any surprises or any worries or concerns that you saw from this month?
So I would agree. This was a solid jobs report. Compared to the April numbers, we're seeing a pickup in growth. And when I think about this compared to the global financial crisis, we're recovering jobs 3 times faster than during that recession. So although it feels a little bit weaker than anticipated, it was a solid report. One of the metrics that the Federal Reserve is looking very closely at is the employment to population ratio, which also rose this month and is good news.
Hey, Kelsey, it's Brian Chung here. I want to ask you about the labor force participation rate. You pointed out the EPOP ratio. That's a positive development, but we did see the LFPA take down a notch. It was only 10 basis points if you're looking at it from a percentage standpoint, but it still raises questions about whether or not there's permanent scarring to the labor market. People have been retiring. In many cases, some people died. So I guess the question is going to be, is the labor market that the Fed is trying to assess different than the labor market that was materially what they saw headed into this crisis?
Yeah, I think that's the question that everybody's asking. And one thing that I've been looking really closely at is the BLS actually asked specific survey questions related to the pandemic. And what they ask is, have you not been able to get a job or been out of the labor force because your employer has closed permanently or has lost business because of the pandemic? There's still 3.5 million people out there who are in that situation. So I think it's a little too early to know if there's been a structural change or if we're still just in the early stages of recovering, the labor market recovering, and these frictions just take time to work out.
Kelsey, I just want to turn my attention now, or your attention now as well, to equities. So I'm looking here on a sector basis. Tech right now is the leader, up just about 1 3/4 percentage point. Of course, we're seeing right now the Nasdaq is the index right now that is leading, up about 1.5%. So we've been seeing this rotation in and out. Of the tech sector. I'm curious to know, as you're looking at the back half of 2021, what you think that narrative is going to continue to be between those growth names, those value names, but particularly on some of those big tech names that had previously led the market. And then we've seen so many people essentially try to flee from and then run back into once we get economic data that seems less than clear going forward.
Yeah, well, in the fixed income market, which is my focus, I think that the backdrop, the low yield environment is supportive for risk assets more generally. So when I think of the second half of the year, I do think of an environment where government bond yields are gradually rising and risk assets have a positive backdrop. We particularly like investing in credit. If you think about something like bank loans, those are tied to a floating rate. So as the economy recovers and yields rise, you're protected from rising yields. And you also get the benefit of strong corporate fundamentals, which is something that I think is a positive for both equity and fixed income investors.
Now, Kelsey, the bond yield discussion is very interesting because if you rewind to earlier in the spring, the discussion was bond yields are going to go much higher. We should expect to see 2% on the 10-year. We're not there. In fact, if anything, the direction, at least for the last few weeks, has been in the opposite direction, retreating from those higher levels. Was that just the bond market, at least on the longer term end, catching up with the Fed's reaction function, or is there something else at play with investor sentiment towards fixed income, at least on the government side?
Yeah, so we see this mainly as a consolidation here. So we had a big repricing in bond yields in the first quarter of the year. And, you know, one thing that I think anchors fixed income yields, and I know that you had a great conversation with President Williams of the New York Fed yesterday about the neutral rate, is the neutral rate of interest is still very low. So while we do expect yields to rise, it's within the context of very low global yields, developed market yields, which is a trend that's been in existence for decades.
All right, Kelsey Berro with JPMorgan's Asset Management. Thanks so much for joining us today, Kelsey. Have a great weekend.